Hello viewers, we'll be going over gold and silver futures. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, going over the current trend with the trend in the past, and we'll go over the day-by-day forecast for gold and silver futures. So back to the technical analysis, gold futures is currently up 1.2% on the 1 hour chart. We had a Fed meeting today and they were dovish, and we could possibly see a good chance of near zero rates up to 2022. So we do have precious metals reacting on that news to the upside. So at the moment, we're nearing overbought RSI on the 1 hour chart. If we expand out to the 4 hour chart, we have now reached 2 positive MACD, and we still have more ways to move higher, and we have not reached overbought RSI yet. If we extend that further onto the daily chart, we start to see that we found a temporary support level that even extended back all the way to possibly it was around a date of April 6th, and we found that support level being around the price of $1,680, and that will be our first immediate support level if we do manage to reverse down lower. And as for resistance, if we do continue to move on higher, the next resistance that I see will be at around a price of $1,763. And if we were to move up higher, that price movement to the upside is roughly around 1.2% to the upside, and to the downside to hit previous support levels, that is around 3.4%. So now let's examine the day-by-day probability model for gold futures. Again, these models are now available in the link below, so do check it out. So as we progress to the 7th day, we have a 20% chance on the extreme case of gold futures climbing higher between 2.3% to 4.6%. To the downside, we have a 40% chance for gold futures to fall between 0 to negative 2.3%. And further on to the downside, we have a 40% chance for gold futures to fall between negative 2.3% to negative 4.6%. So now let's examine the day-by-day forecast for gold futures. So we have 1 day out. That will be a Thursday, and 2 days out will be a Friday, and so on. We have 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. So we compared the current trend, which is the blue line here, and overlapping it happens to be the best match. So we have our current trend right here, and below is a trend that we found on the line graph, and that trend dates back to May 17th to June 29th, 2012. So let's begin comparing the both trends. So on the current trend, we start off at the bottom Bollinger Band, reverse higher to touch the upper band, and then once more touch the bottom band, and then we revert back to the mean. And on the trend question, we start to see a similar pattern here as well. We start off at the bottom Bollinger Band, touch the upper band, and then once more touch the bottom band, and towards the very end we touch the middle band. So what we have here is 1, 2, 3, 4 points, and there's also 1, 2, 3, 4 points on the current trend. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly the same. So the model that we just examined, we just examined May 17th to June 29th, 2012. Back then, gold futures was down roughly around 1.5%. So if we head back to the day-by-day forecast or day-by-day probability model, that coincides with this standard deviation of 40% chance between 0 to negative 2.3% in next coming days. Let's examine closer on the technical performance of each model. So on the current trend that we're in, we're down 66 basis points from monthly high, up 3.4% from monthly low, up 1.3% from 10 simple moving average, and 91 basis points from 20-day simple moving average. And we don't have 50-day simple moving average because we're only examining a 30-day trend. So now the trend that we just examined, again, it was May 17th to June 9th, 2012. Back then, it was down 1.8% from monthly high, up 2.7% from monthly low, down up 70 basis points from 10 simple moving average, and down 99 basis points from 20-day simple moving average. So among the technical, there are technical differences. Most notably is the 20-day moving average down 9 basis points. Compare that to the current trend of up 91 basis points. So now let's examine silver futures. Let's start with the technical analysis for silver. What we have for silver, we mark, if we examine on the 1 hour chart, we are nearing overbought RSI as well as for the 4 hour chart. If we expand out further, we also approach to positive MACD and on to the daily chart. We start to see we are now resting on the, well, that is the 1 hour chart. But if we extend out to the daily chart right here, we have just broken above the 9-day moving average, this blue line. And as indicated in last week's video, we still have possible resistance levels at around a price of $18.90 as our resistance, and our support still remains as $17.42. So if we do manage to climb higher from where we are to reach the resistance level, that price movement to the upside is roughly around 3.8%, and to the downside, that price movement is roughly around 4.3%. So now let's examine the day-by-day probability model for silver futures. So on to the upside, we have a 20% chance for silver to climb higher between 0 to 4.6%. And on the extreme case, we have a 20% chance for silver to climb between 4.6% to 9.2%. And to the downside, we have a 40% chance for silver to fall between 0 to negative 4.6%. And on to the extreme case, 20% chance for silver to fall between negative 4.6% to negative 9.2%. And let's examine the day-by-day forecast for silver futures. So we start off with 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend, as our blue line here. And the trend happens to be, the best match is this trend line over here. And what we have here is our current trend, and below we found the best match, which happens to be the December 3rd, 2008 to March 3rd, 2009, which we found on the line graph. And let's begin comparing the two charts. So on the current trend, we start off at the bottom Bollinger Band, and then we see sideways price action on the middle half of it, and then we start to see another higher highs or averaging above the middle Bollinger Band towards the very end. And right here in the trend in question, we start off at the bottom Bollinger Band, see sideways price action, and we average above the middle Bollinger Band right here as well. And one key difference among two trends is on this trend we see that it dipped below the middle Bollinger Band. However, it reverted back to the mean or middle Bollinger Band, and we don't see that in the current trend right here. So do keep that in mind. There are trend differences among the two. They are similar but not identical. So what we have here is 1, 2, 3 points, and we also have 1, 2, 3 points. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly same. So the model that, again, we just examined, again, December 3rd, 2008 to March 3rd, 2009. Back then, silver was up around, say, 97 basis points or 1% up. And if we examine the day-by-day probability model, that coincides with this standard deviation, 0 to 4.6%, with a 20% chance around that range. Let's examine closer on the technical performance of each model. So on the current trend that we're in, we're down 83 basis points from monthly high, up 34% from monthly low, up 2.2% from 10 simple moving average, up 5% from 20-day simple moving average, and 14% up from 50-day simple moving average. So the trend that we just examined, again, December 3rd, 2008 to March 3rd, 2009, it was down roughly around 13% from monthly high, up 26% from monthly low, down 6% from 10 simple moving average, down 4.6% from 20-day simple moving average, and up 5.5% from 50-day simple moving average. There are technical differences among the two trends. On the trend in question, back then it was down 6% from 10 simple moving average. Compare that to the current trend that we're in. it was down up 2% compared to the past, which is down 6%. And we also have difference on the 20-day simple moving average, down 4%, compare that to up 5%. So there are technical differences among two trends, so do keep that in mind. Again, these models are now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.